Hi everyone, welcome to Refinitiv LPC's Middle Market Weekly Videocast. I'm Diana Diquez, Contributor Relations Manager. This week, we'll look into the non-sponsored middle market. I'll present our first quarter data for this market, but as you will see, COVID-19 had just a little impact in first quarter numbers. However, I will share with you what I have been hearing from bankers that focus on this space. What's keeping them busy? What are their concerns? And what is the impact that they're seeing right now in the non-sponsored space? Let's begin with some numbers. Middle market non-sponsored syndicated loan volume was 16 billion in the first quarter, the same level we saw in first quarter 19. We had not seen these low volumes in this market for 10 years. In this next slide, you can also see that not only was total volume at the same level as in first quarter 2019, but it was distributed exactly the same. There were equal amounts of refis and new money. You can see that on the left. I asked bankers how the market was doing before all the volatility hit. They said that pre-COVID-19, the market was chugging along. I mean, this is a term I've heard a lot of in the last few years, and we have seen relative low volumes in this market. You can look at that in the right. The last few years, volume has not been that great. So that was nothing new. However, they also said that the pipeline was building and they were expecting higher volumes in March. But then the novel coronavirus volatility hit, deals were put on hold, and the pipeline dried out. So how are banks spending their time? Well, like most of us, they're in a lot of virtual calls. They're talking to their clients, helping them figure out what the impact is going to be on their businesses and looking for ways to mitigate the risks. Part of the conversations revolve around drawdowns. Unlike the large corporate market and the sponsored middle market, and also unlike what took place in 2008 in this market, drawdowns have been a lot more restrained so far. Bankers say that corporates are much better positioned this time around. Let's look at the next slide, which provides some insight into this. Here we show M&A volume. During this past cycle, corporate issuers have been very, very conservative. They've limited their expansions and were operating at much lower levels of leverage. If you look at the chart, in the 3 years preceding the 2008 crisis, there in yellow, the average quarterly volume of non-sponsored loans back in M&A was 4.7 billion, and they peaked at 7.5 billion in fourth quarter 2006. Now go forward and look at 2017 to 2019. The average M&A issuance was a much lower 3 billion, with a high of 4.4 billion that took place in 4Q17. In this slide, you can see that corporates have a lot of revolver facilities that they could draw on. In the last 3 years, the share of revolvers of total pro rata non-sponsored lending was 69%, and in the first quarter, it was 67%. So you can see revolvers account for most of the issuance in this market. Now, we might see a change going forward as the massive use of capital that is being allocated to large corporates, which have been drawing on their credit facilities, is going to put a lot of pressure into the traditional non-sponsored middle market. What this means is that bankers are looking very closely at their middle market clients to see if they really need all that credit. And when they come to review their lines, if they're not being used, they might be cut in half. Let's look at the undrawn pricing on these revolvers. While they have been trending downward since 2015, they saw a slight increase to an average of over 30 basis points in first quarter 2020. But where are these headed? Looking back in time, in the great financial crisis, undrawn spreads shot up to an average of almost 75 basis points. However, there was very limited activity at that time, and the average includes a small amount of underliers. Let's now look at drawn spreads. While the average spread for non-M&A related revolvers was up in the first quarter, it was below first Q 2019 levels. in both the traditional and large middle markets. Following the great financial crisis, spreads in the non-sponsored market soared, peaking at 269 basis points in the large middle market and at 267 basis points in the traditional middle market. But we expect to see a shift. Heading into this quarter, half of bankers that took Refinitiv LPC's quarterly survey said they're looking for spreads in the 200 to 250 basis points range. Only 3 months ago, over 60% opted for a much lower 100 to 175 basis points. Another important component in pricing is LIBOR, and you can see that on the right. We show large middle market spreads plus the average LIBOR rate. This represents the total cost for issuers. This year, the average 3-month LIBOR rate is at 1.5%. This is down from 2.3% in 2019. So not surprisingly, we have been hearing that LIBOR floors are again on bankers' minds as a way to guarantee a minimum return. But while we heard that many are asking for LIBOR floors, which can be anywhere between 0 to 75 basis points, they have been facing some pushback. To wrap it up, I want to share some final commentary. While the non-sponsored market is looking in better shape than in the prior crisis, there are many concerns out there. No one really knows how all this is going to look on the other side. And while the first quarter was not too bad, bankers are expecting June numbers to show a hit for almost all the companies in their portfolios. Now, to what extent will companies be affected is not yet clear. Bankers said that they have to wait until May to get a better sense of just how bad things are going to look. Thanks so much, everyone, for listening in. Please check out the full middle market weekly report on Loan Connector, as well as our quarterly features on the sponsored and non-sponsored markets. Thanks again, everybody, and stay safe.